Canada is often described as a stable economy. Yet beneath that calm surface, cracks are becoming increasingly visible. Interest rates have risen at the fastest pace in decades. The Canadian dollar fluctuates with the US cycle. A housing market once fueled by cheap money has suddenly stalled. Macroeconomic indicators still appear resilient, but everyday life tells a different story. Grocery bills rise, rents outpace income, and household debt reaches historic highs. In every economic shock, one fundamental question emerges: who is really paying the price? Not in GDP reports, but in daily financial decisions. As liquidity tightens, credit contracts, and global CDS markets flash early warnings, Canada is not isolated from global forces. History shows that crises rarely arrive with a loud collapse. They begin quietly with a loan that becomes harder to service, a home that cannot be sold, a job that feels less secure. This is where financial divergence begins. Some can absorb the shock, others cannot. Canada's financial landscape is revealing a story where stability comes at an uneven cost. Who is bearing it most? The signs of crisis never appear as a single number. They emerge as a convergence of weak signals. Policy rates rise sharply, increasing borrowing costs, while real incomes lag behind inflation. Canada's household debt-to-income ratio ranks among the highest in the G7, heavily concentrated in housing. A system once flooded with liquidity now slows as credit conditions tighten. Liquidity still exists, but it is unevenly distributed. Large institutions access capital easily, while households and small businesses struggle. Globally, rising CD spreads in emerging markets signaled growing risk aversion. These pressures reach Canada through capital flows and currency dynamics. A weaker Canadian dollar raises import costs, reinforcing persistent inflation. Individually, these indicators may not signal crises. Together, they strain the system. People feel it before statistics confirm it, cutting, spending, draining savings, and growing increasingly uncertain. This is the phase where hidden risks accumulate. To understand how economic shocks unfold, one must examine monetary transmission from institutions to individuals. When central banks raise rates to contain inflation, the objective is to slow credit demand, but the effects ripple outward. Mortgage rates rise, freezing housing liquidity. Prices do not collapse immediately, but transactions stall. Businesses face higher capital costs, delaying investment and hiring. Money circulates more slowly across the system. Those dependent on leverage feel the impact first. Shocks are never evenly distributed because debt structures differ. Asset holders with liquidity can defend themselves. Wage-dependent households become fragile. Currency volatility raises import costs, erodes corporate margins, and suppresses wage growth. The IMF crisis of 1997 showed that crises begin not with a lack of money, but with a loss of confidence. When confidence fades, even available liquidity becomes ineffective. Canada is not there yet, but the mechanics are the same. Shocks reach households long before charts reflect them. Global comparisons help clarify the path Canada must avoid, or could unknowingly approach. Argentina illustrates how inflation, currency collapse, and lost confidence repeatedly erase the middle class. Greece reveals the social cost of austerity. Once public debt exceeds sustainability, Turkey shows how political interference in monetary policy strips interest rates of their stabilizing role. Venezuela represents systemic breakdown, where liquidity loses meaning entirely. Canada differs institutionally, but common vulnerabilities remain: high debt, capital dependence, and external shocks. In a tightening global environment, even safe economies face pressure. These comparisons are not predictions of collapse, but warnings of limits. History does not need to repeat perfectly. Only familiar elements aligned at the wrong time. The impact on Canada is most visible in sectors built on cheap money. Housing, a pillar of household wealth and consumption, enters a prolonged adjustment. Nominal prices may not collapse, but real values erode under inflation and interest costs. Mortgage renewals sharply increase debt servicing burdens, forcing households to cut spending. This contraction spreads into retail, services, and employment. Small and medium-sized businesses face higher borrowing costs amid weakening demand. At the macro level, growth slows without triggering a technical recession, creating a dangerous limbo. The Canadian dollar remains influenced by US policy, limiting domestic flexibility. Liquidity exists, but remains trapped in financial channels rather than flowing into the real economy. Those most affected are not large corporations, but indebted households and cash-dependent small businesses. This is where economic divergence becomes visible. Government and central bank responses operate within narrow constraints. The Bank of Canada prioritizes inflation control, fully aware of the strain high rates impose on borrowers. This is not a moral choice, but a systemic one. Unanchored inflation undermines currency, confidence, and creates deeper damage. Fiscal policy attempts targeted relief, easing pressure on lower-income households. But fiscal capacity is finite, and public debt is a constraint. Greece demonstrated the long-term cost of fiscal indiscipline. Meanwhile, financial markets react faster than policymakers. Credit spreads, risk premiums, and lending conditions shift before official decisions are announced. This creates a dangerous lag. Households feel pain immediately, while solutions arrive slowly. In that gap, anxiety builds and social trust erodes, a factor no balance sheet can measure. Individual survival strategies do not rely on predicting cycles, but adapting to new financial realities. In a prolonged high-rate environment, personal liquidity becomes paramount. Positive cash flow matters more than maximizing returns. Reducing leverage, restructuring debt, and accepting lower living standards are difficult but necessary choices. Argentina and Turkey show that middle classes collapse not from lack of assets, but from loss of cash flow flexibility. In volatile currency environments and illiquid housing markets, assets that cannot be sold become latent risks. Workers must assess their careers like balance sheets. Which skills retain value, which are depreciating? No strategy offers full protection, but understanding one's position in the cycle reduces damage. Financial survival is not about rapid wealth creation, it is about avoiding elimination when conditions deteriorate. The personal impact unfolds as gradual erosion, not sudden collapse. Renters face housing costs rising faster than wages. Homeowners confront mortgage renewals, where each percentage point adds hundreds of dollars monthly. Seemingly minor choices. Delaying children, postponing home purchases, reducing insurance, become collective patterns. This is how macroeconomics seeps into daily life. When living costs rise, but social support lags, perceptions of unfairness grow. Greece showed that middle-class compression weakens social cohesion before official indicators worsen. In Canada, systems still function, but assumed security is fading. The greatest danger is not becoming poorer. It is losing control over one's financial future. The key insight lies in identifying who bears the greatest burden, not the asset-rich, nor capital-accessible corporations. The most exposed group is the highly leveraged middle class, wage-dependent, debt-heavy, and financially constrained. They are not poor enough for broad assistance, yet not wealthy enough to absorb shocks. Historically, this group acts as the shock absorber of economic cycles. The IMF crisis of 1997 demonstrated how adjustment costs are transferred downward through job losses, wage compression, and asset depreciation. Canada faces a similar test, albeit less severe. Recognizing one's role within this structure reshapes expectations. The question shifts from how to win big to how to lose the least. This shift in mindset is crucial in uncertain times. Viewed in full, Canada's financial picture is neither collapse nor clarity. The system remains intact, but the cost of stability is being quietly redistributed. High interest rates, selective liquidity, illiquid housing, and currency volatility form an environment where risk does not disappear, it relocates. History from Argentina, Greece, and the IMF era shows that true crises begin when societies normalize a lower standard as permanent. Canada's story is still unfolding, shaped by how households, businesses, and policymakers navigate this transition. If the cost of survival rises faster than middle-class adaptability, how durable is stability? And if that cost is not shared evenly, who will be forced to change the most as the next cycle unfolds?